Welcome to another episode of Management Unplugged by GR. Today, we dive into the real-world financial gamble that put Lufthansa's chairman Heinz Ruhnau in the hot seat and nearly cost him his job.
Yeah, this is a fascinating one. We're looking at a specific business decision, really high-stakes stuff involving currency risk management at Lufthansa back in the 1980s. And it's a story that, it really shows how even very experienced leaders face immense pressure when volatile markets meet these big strategic moves.
Absolutely. And the stage for this whole drama was set back in January 1985. Lufthansa, the German airline, they were making a huge strategic investment.
Right, buying a whole fleet of new Boeing jets from the...
Exactly, and the price tag.
Yeah.
Pretty hefty, $500 million US.
Yeah, here's the kicker, the really critical part. That $500 million, it wasn't due right away.
Yeah.
It was payable 1 full year later, January 1986.
Okay, so now try and put yourself in Heinz Ruhnau's shoes. He's the chairman of Lufthansa, big job, responsible for the airline's whole future. He's just committed to this massive dollar payment, but the actual cost in his home currency, Deutsche Marks, well, that won't be known for 12 months.
A long time in currency markets.
And what had the US dollar been doing against the Deutsche Mark, leading up to this decision?
Oh, it had been on a strong, a pretty relentless climb since about 1980.
Right.
By January 85, it was trading around DM 3.2 to the dollar, and the trend seemed to be accelerating.
So if that rise just kept going, that $500 million payment could get massively more expensive in Deutsche Marks.
That was the fear. The big, scary risk everyone could see, plain as day.
You could look at the charts, see that steep upward curve for the dollar, and just feel the potential pain. Right?
Yeah, definitely. So Ruhnau, he's got this huge dollar bill coming due way down the road, knowing the final DM cost is completely at the mercy of whatever the exchange rate does in a year's time.
Tough spot.
Right. And when companies face that kind of exposure, they usually have standard ways to try and manage it, hedging alternatives, they call them. Ruhnau and his team, they had to look hard at these options.
All right, so what were the main paths they could have actually taken with that $500 million exposure? Lay them out for us.
Okay. Well, at one extreme, the simplest, maybe riskiest way was to remain uncovered.
Meaning
you just do nothing. You wait until January 1986 and buy the $500 million at whatever the exchange rate is on that day. The spot rate.
Okay, so pure gamble. The final cost in DM is totally unpredictable.
Exactly. Could be great, could be terrible. If the dollar happened to fall dramatically, say down to DM 2.2, that $500 million only costs DM 1.1 billion. Fantastic result.
Best case scenario, maybe.
In hindsight, yeah. But if the dollar had kept soaring, maybe to DM 4.0, that cost balloons to DM 2.0 billion. A massive potential swing. Almost a billion DM difference.
Wow. That kind of variability on such a huge number, it must have felt incredibly risky.
Oh, for sure. It's easy to see why leaving it completely open might look like currency speculation, not really prudent management.
Okay, so that's one extreme. What's the other end?
The opposite end is full forward cover. So back in January 1985, the market was offering a 1-year forward contract rate. It was also around DM 3.2 to the dollar.
Okay.
By signing a forward contract for the whole $500 million, Lufthansa could lock in that exact rate. They'd know precisely what the cost would be. $500 million times 3.2.
Which is DM 1.6 billion.
Exactly. DM 1.6 billion. Fixed.
So that's the certainty option. You kill the uncertainty completely. You know your cost in 1 year, no matter what the spot rate does.
Right. It's often seen as the benchmark,
Yeah.
the risk-averse choice.
Got it. Uncovered or fully covered. Any middle ground.
Yep. There's partial forward cover. The idea is you cover, say, only a portion with a forward contract and leave the rest exposed to whatever the spot rate turns out to be.
Okay.
A common approach, and one they definitely considered, was a 50-50 split. So hedge $250 million using the forward rate of DM 3.2 and leave the other $250 million uncovered, subject to the spot rate in January 86.
Ah, okay. So that smooths things out a bit compared to being fully uncovered.
Yeah, right.
Reduces the potential upside and downside swings.
Precisely. You're still exposed to market moves on half the amount, but it lessens the overall volatility, the potential for, truly astronomical costs if the dollar spike isn't totally gone, but it's halved.
Makes sense. Were there other tools besides just forwards?
Yes, the fourth option involved foreign currency options. Specifically, in this case, buying Deutsche Mark put options, maybe with a strike price around that DM 3.2 level, the current spot and forward rate.
Options. Right.
Yeah.
How would those work here?
Well, the appeal of options is they can protect you against a bad move, like the dollar rising further, but they still let you benefit if the market moves your way, the dollar falling.
So if the dollar went above DM 3.2, you'd use the option, buy your dollars at the 3.2 strike price. Your cost is basically capped at DM 1.6 billion, plus the cost of the option itself.
Exactly. You have to pay an upfront premium for the option. Yes, it caps your maximum cost plus that premium.
And if the dollar fell below 3.2,
Then you wouldn't use the option. You'd just let it expire worthless. You'd go to the spot market, buy your dollars at the cheaper rate, say DM 2.3, whatever it is. Your total cost would be that spot cost plus the initial premium you paid.
okay, so you still benefit from the fall, just minus the premium cost.
Yeah.
But that premium, was it significant?
Oh, yeah. For this size of deal, in January 85, the premium was quoted at DM 96 million. That's about 30 million US dollars at the time.
96 million DM, just for the right to maybe buy dollars at 3.2.
Yep. And that's a big psychological hurdle for, treasurers and executives, paying that much up front for something you are actively hoping you won't need.
Right. You hope it expires worthless if you think the dollar's going down.
Exactly. It can feel really expensive, especially if you have a strong personal view on where the market's heading, like paying a giant insurance premium when you feel pretty sure the house won't burn down.
Yeah, I get that. It provides the protection, but it feels like money down the drain if you're right about the market.
Precisely. And there was one more possibility, a fifth one, basically a money market hedge, to buy the dollars now.
Just get the $500 million straight away.
Yeah, you'd borrow the funds or use existing capital, buy the $500 million immediately in January 85, and just sit on it until the payment was due a year later. Completely removes the exchange rate risk.
That sounds pretty straightforward, maybe the simplest.
Yeah.
Was it feasible for Lufthansa, though?
Turns out, not really in this case. The source material points out a couple of big constraints. First, the financing for the planes themselves wasn't set up to give them that lump sum of capital right at the start. The funds were planned for the payment date a year out.
Oh, okay. Cash flow timing.
Right. And second, this is often critical for big companies like Lufthansa, they had very strict debt covenants in place.
Rules from their lenders.
Yeah, essentially rules from their banks and bondholders that limited the types of debt they could take on, the amounts, even the currencies they could borrow in. Borrowing an extra $500 million equivalent immediately, well, that likely would have violated those agreements.
Okay, so buy dollars now, while it sounds simple, was pretty much off the table because of Lufthansa's specific financial setup and existing rules.
That seems to be the case. So that left Ruhnau really looking at 4 practical choices: remain uncovered, full forward, partial forward, or use the option.
Right, and this is where it gets really interesting because you mentioned here Ruhnau had his own view, right?
He did, and this is crucial. Despite that scary upward trend of the dollar that everyone was watching, that graph going almost vertical,
Yeah.
he held a strong personal conviction. He genuinely believed the dollar had peaked. He thought it was overvalued and was actually going to fall by January 1986.
Wow. So his forecast was pointing one-way dollar down, but the recent market action and, general corporate risk aversion must have been pushing towards hedging, maybe that full forward or the options.
Exactly. A real dilemma. What did he decide?
Yeah, what did he do?
Well, he decided against going fully uncovered, even though that matched his prediction.
Oh, why not? If he thought it would fall.
He apparently felt that leaving the entire $500 million completely exposed, given that strong, accelerating upward trend they'd just seen, it was just too risky for Lufthansa.
Okay.
The potential downside, if he was wrong and the dollar kept climbing, was just too severe to gamble the whole amount purely on his personal forecast.
Right, so he wasn't willing to bet the entire farm on his prediction, even if he felt strongly.
Seems not. And he also shied away from the options. Primarily, it seems, because of that big DM 96 million premium.
The cost factor again?
Yeah. He expected the dollar to fall, which meant the option would likely expire worthless anyway. And paying that huge upfront cost for protection, he believed, deep down, wouldn't actually be needed. It just felt like too much.
Okay, so not fully uncovered, not options.
Yeah.
That leaves.
The middle path. He chose the partial forward cover, that 50-50 split.
Ah, so lock in half at the DM 3.2 forward rate and leave the other half exposed to the spot rate in a year's time.
That was his decision. Hedge some of the risk, provide some certainty, but still leave the company partially exposed to benefit if his prediction of a falling dollar turned out to be correct.
A compromise, really, between his market view and the company's need for some risk management.
That's a good way to put it, a pragmatic compromise, perhaps.
Okay, so the decision is made now, the moment of truth. Fast forward to January 1986. What actually happened in the currency market? Was Ruhnau right about the dollar's direction?
He was absolutely spot on. The dollar didn't just fall, it plunged.
Really?
Yeah. By January 1986, the exchange rate had dropped dramatically. From that DM 3.2 level down to DM 2.3 to the dollar.
Whoa. 3.2 down to 2.3? That's a massive move.
Huge move. His directional prediction was perfect.
Okay, so let's look at the scoreboard then. Given that actual spot rate of DM 2.3 in January 1986, what would each of those strategies have actually cost Lufthansa? Start with the riskiest one.
Okay, if they had been fully uncovered, just waited and bought dollars at the spot rate of DM 2.3, the cost would have been $500 million times 2.3. That's DM 1.15 billion.
DM 1.15 billion. Okay? That's the number to beat, sort of, in hindsight.
Right, that was the cheapest possible outcome given what happened. Now, if they had chosen full forward cover, locking in DM 3.2 a year earlier.
That cost was fixed, right?
Fixed at DM 1.6 billion. That's what certainty cost them.
Okay, 1.6 billion, quite a bit more than the uncovered 1.15 billion. Now, what about Ruhnau's actual choice, the partial forward cover, the 50-50 split?
Right. So half, $250, was covered at DM 3.2, costing DM 800 million. The other half, $250, was bought at the spot rate of DM 2.3, costing DM 575 million. Add those together.
Comes out to DM 1.375 billion.
Exactly. DM 1.375 billion.
Okay. So better than the full forward cover, but still significantly more expensive than just being fully uncovered.
Correct. Now, what about the DM put options? Remember that DM 96 million premium?
Right. Since the dollar fell way below the 3.2 strike, they wouldn't exercise them.
Correct. They'd let the options expire worthless. They'd buy the $500 million on the spot market at DM 2.3, costing DM 1.15 billion.
But they still paid the premium up front.
Exactly. So the total cost for the option strategy would be the spot cost, DM 1.15 billion, plus the premium, DM 96 million. That totals DM 1.246 billion.
DM 1.246 billion. Okay, let's recap those final costs in hindsight.
Uncovered, DM 1.150 billion. Options, DM 1.246 billion. Ruhnau's partial cover, DM 1.375 billion. Full forward, DM 1.600 billion.
So here's the amazing, and I guess for here, Ruhnau, the really painful twist. He predicted the dollar would fall, and it did, massively.
Yeah.
Yet his chosen strategy, the partial forward cover, the compromise, it ended up costing Lufthansa DM 225 million more than if he had just done nothing and stayed fully uncovered.
225 million Deutsche Marks, a huge sum. And it also cost DM 129 million more than if he had used those foreign currency options, even counting their big premium.
Gotcha. He was right about the market direction, but the specific hedge he chose turned out to be, well, far from the best one, given that specific outcome.
Precisely. The tool didn't fit the outcome perfectly, even though the forecast was right.
The backlash must have been immediate and brutal.
Oh, it was. February 1986. Ruhnau gets summoned by the German transportation minister. He had to face a very, very unhappy Lufthansa supervisory board.
I bet.
And his political rivals, both inside Lufthansa and outside, they just pounced. The knives came out. They accused him flat out of recklessly speculating.
Recklessly speculating. But isn't the irony just incredible here?
Explain.
Well, they accused him of speculating because he used a forward contract for half the amount. That's the tool designed to reduce risk, to provide some certainty.
Yeah.
It wasn't the uncovered part of his strategy. They focused on the part that actually benefited from the falling dollar he predicted. They hammered him for the part that limited the risk, because in hindsight, that limiting part cost them money, compared to having no limits at all.
It's perfectly ironic, isn't it? Hindsight completely twists the perception of risk. They leveled 4 specific charges or mistakes against him.
Okay, what were they?
First, they said he shouldn't have bought the aircraft at all back in January 85 because the dollar was supposedly at an all-time high.
Which seems, kind of unfair, right? Airlines need planes. You can't just perfectly time massive fleet renewals based on guessing currency peaks.
It's a tough criticism. Second charge, choosing any hedge at all, the partial cover, when his personal gut feeling told him the dollar would fall.
The if you believed it, you should have gone all in argument.
Exactly. The argument was, if he truly believed it would fall, he should have gone whole hog, stayed completely uncovered, and reaped the maximum benefit.
Again, that's purely judging the decision based on the outcome, completely ignoring the very real, very significant risk he was consciously managing back when he made the call.
Totally. Third accusation, choosing forward contracts instead of options as his hedging tool.
Okay, this one has maybe a bit more technical merit in hindsight.
Well, the argument was that options would have given him protection if the dollar had risen, plus allowed him to benefit fully from the fall, minus the premium. As we saw, options would indeed have been cheaper than his partial cover strategy, given the outcome.
Right. DM1.246 BN versus DM1.375 BN. Still more than doing nothing, but better than what he did.
Correct. And the fourth charge. This added a layer of sort of external political pressure. They questioned buying Boeing aircraft at all.
Ah, the Airbus connection.
Precisely. Given German and wider European economic community interests in supporting Airbus, Boeing's big rival, buying American planes was always going to attract some political scrutiny.
So a mix of financial hindsight, strategic second-guessing, and maybe some industrial politics thrown in.
You got it. And all these accusations boiled down to one very stark question before the board. Should Herr Heinz Ruhnau be terminated as chairman of Lufthansa?
Wow. His job was really on the line because of this hedging decision, even though his market call was right. So, stepping back from the drama, what are the key takeaways here? What can we learn from this whole episode? It's more than just an old story about currency trading, isn't it?
Oh, absolutely. It really, really underscores that managing financial risk, especially something like currency exposure on these huge long-term deals, it's just not as simple as predicting which way the market will go.
Right. Ruhnau was right about the dollar falling.
But his choice of tool and strategy, the partial forward cover in the face of that uncertainty, well, it ended up costing the airline a lot compared to other options he had on the table, given how things actually played out.
And it just screams about the power of hindsight bias, doesn't it? We have to evaluate decisions based on the information and the risk landscape that existed at the moment the decision was made.
Exactly. Back in January '85, the dollar was soaring. Leaving $500 million completely uncovered felt incredibly risky and, objectively was very risky, no matter what your personal forecast might have been.
Yeah. And it also clearly shows how these different hedging tools doing nothing, forwards, options, they just have fundamentally different results, different payoff profiles.
Totally. Forwards give you certainty, but you pay for it if the market moves favorably beyond the locked-in rate. Uncovered gives you the full potential swing, max risk, max reward. And options, well, they give you protection plus that potential upside, but they come with that upfront premium cost. They aren't free insurance.
And the cost of a hedge. It can look really different depending on what happens next. Ruhnau's forward cover looked expensive in the end because the dollar fell so much.
Right.
But it did achieve its goal of limiting the potential disaster if the dollar had kept soaring. That was the insurance premium he paid for downside protection.
Absolutely. And, this case is a great reminder that these big corporate decisions, they're always messy. You're balancing market forecasts, financial tools and their costs, internal rules like debt covenants, the company's overall risk tolerance, and, sometimes even those external political or industrial pressures.
And maybe the most provocative point for me is how that word speculation got twisted.
Yeah.
Ruhnau was accused of speculating with the forward contract, which is normally seen as a risk-reducing tool. Not with the decision to leave half the money uncovered, which was actually the part that carried the initial high risk, but ended up delivering the gains.
It's bizarre when you frame it like that, isn't it?
It really makes you wonder how often leaders get hammered based purely on outcomes, rather than on the prudence, the logic, the risk management process they followed at the time.
It's a powerful lesson. Navigating uncertainty involves making these tough choices. And, well, being right about one part of the puzzle, like market direction, doesn't always guarantee overall success or shield you from criticism when the dust settles.
So let's leave our listeners with this thought. Thinking about this case, knowing the pressures Ruhnau was under, the soaring dollar trend he faced, the tools he had available back in January 1985, how would you evaluate his decision at that moment? Was the intense criticism he faced truly fair, based on the information and the risks he had then? Or was it mostly just the harsh, unforgiving judgment of hindsight, maybe combined with a bit of bad luck on the specific hedging tool he chose, even though his big market call was actually spot on? Something to definitely mull over next time you're looking at a complex decision made under deep uncertainty. Bye. See you later.